Hi, I'm Stephen Dooley, Head of Market Insights here at Convera, and today I'm going to walk you through our monthly FX research report, the Global FX Outlook. August was very much defined by a weakening in the US dollar. The US dollar fell to 13-month lows on the back of growing expectations that the US Central Bank, the Federal Reserve, would cut rates as soon as September. There were two big factors driving the realization that a Federal Reserve rate cut is nearing. First of all, a weaker than expected result in the monthly employment numbers at the start of the month. And then towards the end of the month, the Federal Reserve Chair, Jerome Powell, said the time has come for interest rate cuts at a key speech at the Jackson Hole Economic Symposium. The US dollar ended down around 2.5% for the month of August, as measured by the US dollar index, and it had the impact of pushing quite a few other currency pairs to new highs. The most notable was the euro, which has really outperformed, moving up towards that 112 level on the euro dollar, because markets are now less convinced that we might see rate cuts from the European Central Bank than we might see from the Federal Reserve. In fact, looking at the expectations for rate cuts, there's around 200 basis points of cuts priced in to the US Federal Reserve over the next 12 months. There's only around about 120 basis points of cuts priced in for the euro. So that helped the euro strengthen over the course of August, although it did lose momentum at the end of the month. The British pound was also strongly higher over the course of August, moving up above that 130 level on the British pound US dollar pair, and in fact moving to a level that was higher than any point in the last 2 years in the British pound US dollar pair. Again, we saw some weakness at the end of the month. The Australian dollar also climbed versus the US dollar last month, climbing up to the highest level since early 2024. The Australian dollar is in a somewhat unique situation, one of the few central banks in which we haven't seen signs that we might see rate cuts. The Reserve Bank of Australia remains concerned about inflation and has given no indication that we might see lower interest rates soon. Okay, now let's have a look at some of the key points in the global economy as we go into the month of September. Well, there's a couple of key themes to watch. First of all, as we mentioned earlier, the US dollar really losing its crown. That's been one of the defining themes of 2024, is just how strong the US dollar has been. The reason why is because markets went into the new year thinking we get rate cuts from the Federal Reserve early in 2024. Those rate cuts didn't appear, and as a result, the US dollar was stronger, also helped by stronger economic growth. But as we got into July and August, we saw quite a significant weakening in the US dollar. The other big theme is that right around the world, central banks are now expected to cut interest rates. That's not all good news, because part of the reason why is we're seeing quite a significant slowdown in the global economy. And if we look at how often economic data has been beating expectations, that's come down quite significantly over the last 6 months, notably in the UK, in the Eurozone, and in the US, although New Zealand appears to be a bright spot. Another factor that's weighing on the global economy is that China doesn't seem to be able to recover its economic momentum. And that's been a real theme since the end of those lockdowns that we saw throughout China in 2022. That consumer confidence has remained weak. Concerns about the construction and property sector has underperformed. And of course, we've seen the Chinese government only slowly look to provide stimulus in the means of fiscal policy or indeed lower interest rates. We have seen some interest rate cuts from China over the last couple of months, but some observers worry that it might be too little too late. And you can see here in this chart that Chinese equities likely to see the 5th straight year of outflows. So as I said earlier, one of the big themes is going to be that we're likely to see more rate cuts as we go into the second half of 2024. And the million-dollar question is whether these rate cuts will come at a time where we see economic growth only slowly weaken, or whether it falls more substantially lower, creating the concerns for a broader equity market sell-off. So for now, you can see that markets have become more calm. That big equity sell-off that we saw at the end of July and the start of August, which saw a huge spike in volatility, you can really see that in the black line there. That's at the close of that big sell-off that we saw at the start of August. But since then, we've seen volatility indicators move back to a more normalized manner. So for now, markets are feeling confident that these rates cuts are going to come, but during a period in which economic growth only slows moderately, not significantly. But that's going to be the key question as we go into the end of 2024. What happens if growth slows more significantly? What's interesting about these rate cuts that we're likely to see is that part of the volatility that we saw in July, in August, was driven by a divergence in policy as the Federal Reserve looked to cut interest rates, and in particular, the Bank of Japan looked to hike interest rates. That's why we saw so much of that volatility in the US dollar Japanese yen pair, and that remains the real focus for FX markets going into September. We've got a big policy decision from the Federal Reserve and a big policy decision from the Bank of Japan. They're the exact same set of conditions that drove that volatility at the end of July and the end of August. So policy divergence, as some central banks tighten and some central banks loosen, have the capacity to drive volatility across FX markets. Okay, so let's have a look at some of the details around FX markets that we look at each month in the Global FX Outlook. What we like to start off looking at is to hone in on some of the volatility measures that we look at each month. And what's interesting is that so far this year, volatility has remained relatively low. If we look at these key currency pairs that we monitor, the only pairs where we've seen a significant step up in volatility compared to historical norms is really the US dollar versus the peso and the US dollar versus the Japanese yen. In other markets, like the Australian dollar versus the US dollar, the Kiwi versus the US dollar, or the US dollar versus the Canadian dollar, you can see that volatility is actually relatively low. And for an example, the Aussie-US pair historically moves on an average annual range of around 19%. And here we are 3/4 of the way through, well, almost 3/4 of the way through the year, and the Australian dollar's only moved in a less than 8% range. So remarkably low volatility that we've seen so far this year. That said, we could see a spike, particularly going into these central bank decisions, and of course the build up to the US presidential election in November. Another factor we try to look at is where is the current value in markets. And the way that we do this is to measure a currency's current position versus a historical average. And so you can see here in the dark green signaling a greater value compared to the historical average. So the US dollar peso here, 11% up above its year-to-date average, showing you that that's well above where we've traded for most of the year. You can also see the pound and the euro above where the market has traded for most of this year in terms of a year-to-date average. On the downside, dollar CAD and the dollar yen are below the year-to-date average so far, indicating that they're below the historical average so far this year. In the next section of the report, we look at the FX forecasts and where we see the core central scenario for the year ahead and what a sudden spike in market activity could drive the market in any other direction. So looking at the euro US dollar, as I mentioned, trading above 110 as we record, the focus for the balance of this year is for the market to trade around about between 107 up to around 110 for the course of this year, and the center point there around 109. So currently a little bit above those forecasts. Again, markets, of course, as we mentioned, tend to move in quite large swings. So what could drive a spike higher in the euro US dollar? Well, it's going to come down to a recovery in the Eurozone economy, which has been underwhelming so far this year. What could drive a more significant move lower down to 106 or 104? By the same token, a more significant slowdown in the Eurozone. But for now, you can see that central scenario over the balance of this year around 107 to 110. In the British pound versus the US dollar, again, you can see the overall range for the year ahead from around 125 to around 129. Up until August, we saw the British pound US dollar pair basically capped between 130 or below 130, but has managed to pop up higher as we saw that US dollar weakness. But for the balance of the year ahead, we're looking at that zone between 125 and 129 for the balance of 2024. In the dollar CAD, of course, the dollar CAD was also lower in the course of August as a result of that US dollar weakness. But the Canadian dollar has overall been in a more weakening phase over the course of 2024. We've already had 2 interest rate cuts from the Bank of Canada. We've got another Bank of Canada decision early in the month, early in September. And that could continue to add some pressure to the Canadian dollar. So again, the range that we're looking at over the balance of 2024 from 137 up to 139 for the dollar CAD. Finally, the Aussie dollar. And again, the Aussie dollar has been a market that has been mainly trapped below quite key technical levels, below 68 cents. For most of this year. We've managed to briefly pop its head above that level near the end of August, but not in any sustained manner. Again, looking out to the balance of this year, a range from around 64 up to 68, which has been basically the range the market has traded in all of 2024 so far. What could drive the Aussie dollar higher? Well, in the first instance, as we mentioned earlier, the Reserve Bank of Australia has been quite consistent in its concerns about inflation, about its unwillingness to cut interest rates, even as other central banks cut interest rates. And so that's going to be the key story for the Australian dollar, is whether the Reserve Bank of Australia does turn and does fall in line with other central banks. That could pressure the Aussie dollar. However, it continues to hold fast and keep interest rates on hold. That could be supportive of the Aussie dollar. That said, that weakening in the China story has really been the major cap on the Aussie US for most of this year. I mentioned earlier that we have some big central bank decisions, and as we look ahead to the key market events to watch, it really is about central banks this month. First of all, as we mentioned, the European Central Bank does meet on the 12th of September. That'll be closely watched, but really it's the next week, that third week of September, in which we get a major flurry of central bank decisions, particularly on the 18th US time with the Federal Reserve decision. As we said, markets are looking for a rate cut of around 25 basis points. It could be 50. That will really depend on some of the data that we get throughout the course of September. As we mentioned, the Fed on the 18th, on the 19th, the Bank of England, and on the 20th, the Bank of Japan. So that third week of September, absolutely critical in terms of central bank decisions. In terms of data, we mentioned the Federal Reserve is going to be watching a couple of big releases. First of all, that US jobs report on the 6th of September, US time, and then the next week on the 12th of September, US inflation. They're going to be the two key measures that really drive that decision-making for the Federal Reserve. And of course, we also have key releases from China that we'll be watching over the course of this month to see whether we do see any improvement in growth from China. And as we mentioned in Australia, that jobs report on the 19th also closely watched. Well, thanks for taking the time to watch the video. I hope you found it useful, and please, if you need more information, you can download this report from the Convera blog or reach out to your representative here at Convera. Thanks again for your time, and look forward to joining you again next month. Thank you.